Yeah, I know that gold and silver were down this past week. I'm aware that there are tons of YouTube channels that are expressing either confusion or outrage because they think the metals should be higher. I'm not going to focus on that today because, frankly, I don't see that this week's price action is all that important in the grand scheme of things. Gold and silver are volatile metals, folks. Get used to it. For the 25 years or so that I've been a metals investor, there have always been large dips in price, often when it didn't seem to make sense. All I really want to say on that matter is that early last year, gold bottomed at $1,473 per ounce, and silver bottomed at $11.95 per ounce. So gold's up in price 21% from the yearly low, and silver's up 128%. They've done their job. They will continue to do their job, but don't expect immediate gratification. They deliver the goods in their own time. What I want to discuss today is for those of you who choose to diversify your holdings outside of the metals and place some of your savings in equities. I'm going to use the S&P 500 as my example today, but the same message applies to any large capitalization weighted index fund. There is a big problem in the way that most passive index funds are constructed. The amount of each stock in the index is directly proportional to its market value or market capitalization. For those of you who are not familiar with market capitalization, it is simply the share price multiplied by the number of shares outstanding. It is the estimate the market gives to the value of an entire company. One of the reasons capitalization-weighted index funds and ETFs are set up this way is that it minimizes turnover. If the index owns ExxonMobil, for example, and ExxonMobil goes up in price by 10%, the relative weighting of ExxonMobil in the index increases, and so the index fund doesn't need to sell. This reduces transaction costs for the shareholders and also minimizes taxes. But you know what else it does? It results in a large concentration of the most popular names. Look at this breakdown that I created here. Notice that close to 20% of the index of 500 companies is in only 6 names. You will all recognize the names. They are Apple, Microsoft, Amazon, Facebook, Google, and Tesla. So if you buy an S&P 500 index fund this week in your retirement account, for example, then close to 20% of the money will be going into these 6 names. And a full 6.3% of it will be going into Apple stock alone. Now, you may not intend for this to happen, but that's what's going to happen. Notice that the next 35 companies represent about 41% of the index. So if we really dive into the details of this index, about 60% of it is concentrated into about 40 companies. Haha, it's a real 60-40 portfolio. But seriously, is this diversification? Absolutely not. And it's certainly not the kind of diversification that is implied by the name of the index, S&P 500. It suggests owning 500 companies, which it does. But the performance is dominated by what happens to the largest of the companies as measured by market capitalization. Such a system of construction creates a type of momentum. The most hyped up names end up with the largest market share. When the passive index crowds put more money into the index, the vast majority of it is used to purchase the hyped up names with the highest valuations. So instead of the S&P 500 being a value-oriented fund, it is really a type of momentum fund. And momentum can go both ways. Let's see what happened to the market leaders of the tech bubble of the late 1990s. On the left-hand side, we can see who the top 10 stocks of the S&P 500 were in 1999. We had Microsoft, GE, Cisco, Walmart, ExxonMobil, Intel, Lucent Technologies, IBM, Citigroup, and America Online. It was a strange time in the late 1990s. I remember conversations that I had with people where I expressed that I just didn't understand the valuations being given to the high-tech firms such as Microsoft, Cisco, Lucent, America Online, and a host of others not shown here, such as Qualcomm. All I heard back then from my friends was that I should just buy so that I didn't miss out on all of the gains. Weird things were happening, such as Pets.com buying a prime advertising spot at the Super Bowl. The company didn't have any profits, but there it was spending millions on advertising. America Online, a company that specialized in dial-up internet service, had such a hefty stock valuation that they were able to buy Time Warner in a stock deal. But now focus your attention on the right-hand side, which shows the top 10 companies in 2004. Only 6 of the leaders from 1999 are still on the list: Cisco, Intel, Lucent, and America Online aren't there. And this is especially damning of the America Online because the merged company that was AOL Time Warner and eventually just called Time Warner isn't there either. Microsoft dropped down a couple of notches and lost more than half of its market capitalization from 1999 through 2004. GE took the top spot, though we know that they had a fall from grace over the past 2 decades, and now they have a market capitalization that's about 1/5 of what it was in 1999. In 1999, the total market capitalization of the S&P 500 stock index was about $11 trillion. 5 years later, in 2004, it was about $10 trillion, or about 9% lower. Notice that the total capitalization of the top 10 stocks in the index dropped by 23% over the same time period, and the leaders are not even in the same group. That means that a portfolio of just the top 10 stocks in 1999, if held by itself and not readjusted, as the S&P 500 capitalization approach would have you do, you would have lost more than 23% compared to the 9% lost by the overall index. So what we can see is that cap weighting can be quite dangerous. It prevents the sale of the high flyers. It forces a greater percentage of new investment to be concentrated in the popular names. Now, I think this is a mistake. Investors are not rewarded for doing what's comfortable. They are rewarded for doing what's uncomfortable. Let me show you a simple example of how to achieve diversification in the stock world without it costing an arm and a leg. There is a fund that has been around since 2003. It is the Invesco Equal Weighted S&P 500 ETF. It has bought equal percentages of each of the 500 stocks in the index and rebalanced periodically. Now, it's certainly not the most sophisticated way of avoiding the high flyers, but it does reduce the drag associated with always having a large amount of money invested in them. And here's what it would have looked like compared to the capitalization-weighted S&P 500. Even with the significantly higher expense ratio, it managed to turn every $100 invested into $691. The S&P 500 cap-weighted index, by contrast, turned each $100 invested into $598. Today, the process of buying an equal dollar amount of each stock is much simpler. You don't even need a mutual fund or ETF to do it. Now, I did the math, and if a person had been able to do this in the past and rebalance each year on their own, they would have turned $100 into about $800. Now, I'm not proposing that a person buy each of the 500 stocks on the S&P 500 index equally. I'm just making a point here. What I am suggesting is that those of you who hold a balanced precious metals and stock fund think about some intelligent ways to deploy your equity funds. Cap weighting is a recipe for suboptimal performance, as this simple chart shows.